This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello, everyone, and welcome back to the Financial Standard podcast. My name is Eliza Baven, and I'm a senior journalist here at Financial Standard. Today, we're talking about portfolio construction. The aim of any good portfolio is to build one that aligns with clients' needs, but as we all know, those needs can be constantly changing and evolving, not only when it comes to life stages, but also by what's going on in the world at the time in markets and economically. So joining me today to give her insights is Mercer Portfolio Solutions Lead, Rebecca Jacques. Welcome to the show, Rebecca.
Thank you. Nice to join you today.
So let's start more broadly. What is Mercer's approach to portfolio construction?
Our actual investment philosophy is entirely centred around the client objectives. And this is because the right solution actually depends not just on the client and their objectives, but also the region that they sit in and their circumstances. But underpinning that, I guess, there's sort of some core pillars that we think about. One of them is strong governance, right? So that's about aligning the actual decision-making framework and the implementation framework to the client objectives. You do need to be rewarded for risk, right? So at the core of what we focus on is obviously getting your asset allocation correct on the medium to long term and making sure that, you know, when you're selecting managers and you're trying to create that value, you're actually getting rewarded appropriately for where you're actually taking risk. And the other side of it is in essence maximising the value you can get. A lot of people think that once you've set your asset allocation, you can just go through and identify the best managers. The challenge is it's actually harder than that to combine them so that you actually build a process that gets, essentially exceeds the sum of its parts. And they really underpin what we do. So at the very core of what we actually focus on for an investment philosophy is making sure that the solution is embedded in the client's investment objectives.
And for decades, the 60-40 portfolio of equities and bonds was the gold standard. But there has been some chatter recently saying that those days may be over. Do you think the balanced 60-40 portfolio is dead?
So a lot of that argument really stems from the concept around that the 60-40 is just equity bonds. And I guess we, for a number of years, really haven't looked at portfolios just from that sort of equity bonds sort of lens. And it's really about thinking about the total portfolio answer. So it does mean you have to span across both public and private markets. And it does also mean you have to really delve down into sort of sub-strategies. So, fixed interest correlations may converge or have more periods in time when they converge with equity correlations. But some of the sub-strategies within what we would classify as sort of fixed income or debt side of the portfolio, like private credit, like even multi-asset credit, all those sorts of areas, will actually deliver to portfolios during different periods of time. So to us, the 60-40 is not dead, but that's largely because the 60-40 for us encompasses a whole range of different assets. Whether they're in the growth or defensive bucket, again, will also depend on the client's objectives. So we do sort of really treat some asset classes as hybrids between the two. So particularly when you look at like alternatives, we think of alternatives in the alternatives growth space and then also the alternatives defensive space. So in short, no, we don't think it's dead. But within that statement, you've got to understand that we think at the total portfolio level across multiple different layers of sub-strategies.
And one of the main themes impacting everyone this year has been the increased cost of living, thanks to climbing inflation, and of course, as a result, the higher interest rate environment that we find ourselves in. Should portfolios be constructed differently in a higher interest rate environment?
In short, yes, because the reality of it is that like we just touched on before, the correlations between asset classes, they're not static, right? And nor are they stable. But we do know that it's sort of in higher interest rates, sort of slower growth environments, the equity bond correlation sort of, starts changing around, right? And in essence, what it means is that you do get more periods when equities and bonds will behave in the same direction. So ultimately, yes, that means you've got to broaden your horizons in terms of what sub-strategies you look at. I think it's also important to recognise that not just the interest rate sort of growth environment has changed, but there's also been quite a structural shift in the way companies now raise assets or get finance. And that is underpinning that growth in the private markets, which is therefore meaning, and what that does is it actually leads to a compression of returns in public market space. And so therefore, to get the same level of returns to deal with inflation, you do need to think outside of that sort of just public, equities and public debt arena. The one positive that comes of a higher type of inflationary interest rate environment is that cash no longer is a dead weight in the portfolio. But people do still need to recognise that cash still can work as a drag, particularly in terms of staying and keeping pace with inflation. But it does give you greater flexibility to sort of put money into cash for short periods of time and know that it's actually doing something for you versus absolutely nothing, which it was doing before.
And how can wealth managers design portfolios that will yield better results for clients?
So the real challenge, I think, is essentially around the concept around liquidity, right? And we've had this argument in our industry for a long period of time. Investors, I think, really need to challenge that concept of how much liquidity they really need. When you think of investments in our super space or in our wealth accumulation space, you're talking 20, 30 years that you're investing for. And so really requiring your whole entire portfolio to be daily liquid is probably not necessary, right, when you're investing for that long periods of time. What it does mean, though, is that you need to work in partnership with, the platforms, the advisors, all of the people along that portfolio construction chain effectively to ensure that there is liquidity buckets available to meet those sort of daily or weekly or monthly liquidity cycles. But that, to me, is at the heart of what needs to really be challenged, because the illiquidity done right gives you a higher reward for the risk that's taken. It also, forces you to put stronger governance processes in place around your portfolio and how you manage it. And it then ensures that you're actually maximising the value add that you're able to create for the clients.
Well, Rebecca Jacques from Mercer, thank you so much for sharing your thoughts with us today. We very much appreciate it.
Thank you very much.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.